Gold plunges after historic sell-off as precious metals face sharp repricing. Gold and silver have entered one of the most violent reversals seen in decades. After reaching historic highs only days earlier, precious metals extended a sharp sell-off at the start of the week. What began with a dramatic collapse on Friday has turned into a broader repricing driven by volatility, profit-taking, and shifting macro expectations. Spot gold fell roughly 5%, trading near $4,600 per ounce, following a near 10% plunge from above $5,000. Silver suffered an even steeper reversal, collapsing about 30% on Friday before sliding further in early trading. The speed and scale of the move mark an abrupt end to a rally that had been fueled by safe haven demand, speculative inflows, and expectations of easier monetary policy. A textbook correction after extreme gains. Market participants broadly described the move as a textbook correction after an extraordinary run. Gold and silver had surged at an unsustainable pace. Expectations for U.S. interest rate cuts, geopolitical tension, and concerns about political interference in monetary institutions attracted heavy inflows. When positioning becomes crowded, even modest changes in expectations can trigger outsized reactions. That dynamic appears to have played out as investors rush to lock in gains and reduce leverage. Importantly, the sell-off does not automatically signal a structural breakdown in the longer-term bullish case for precious metals. Instead, it highlights how vulnerable momentum-driven markets become once sentiment turns. Dollar strength shifts the balance. A strengthening US dollar has been a key driver of the pullback. The dollar index rebounded sharply, applying direct pressure on dollar-denominated commodities. A stronger dollar makes gold more expensive for international buyers and reduces its appeal relative to U.S. assets. At the same time, firmer yields increase the opportunity cost of holding non-interest-bearing assets like gold. This inverse relationship between the dollar and precious metals has reasserted itself forcefully after being temporarily overwhelmed by speculative enthusiasm. Earlier in the rally, monetary policy expectations reset. Behind the dollar move lies a sudden reassessment of U.S. monetary policy. Markets had priced an aggressive easing by the Federal Reserve, but that narrative weakened as political developments raised the prospect of a less accommodative policy direction. Signals pointing toward tighter or more cautious monetary leadership strengthened the dollar and undercut demand for gold as a hedge against monetary debasement. Even without an immediate policy change, shifting expectations alone were enough to trigger a violent repositioning. Uncertainty about the future path of rates is now a central driver of volatility across commodities, currencies, and bond markets. Higher margin requirements amplify the fall. Technical factors in derivatives markets added fuel to the decline. Exchanges raised margin requirements on gold and silver futures, forcing traders to post additional collateral or cut exposure. In periods of extreme volatility, higher margins often lead to forced liquidation, especially among leveraged participants. This feedback loop can accelerate declines and exaggerate short-term price moves. While such measures are designed to protect market stability, they also tend to drain speculative liquidity rapidly, reinforcing downward momentum. Silver hit harder by speculative unwind. Silver once again proved far more volatile than gold. While gold is primarily held as a monetary and reserve asset, silver has significant industrial exposure and typically attracts more speculative trading. The magnitude of silver's collapse suggests that a large portion of the rally was driven by short-term positioning rather than long-term demand. When sentiment reversed, the unwind was swift and severe. Despite the drop, silver remains well above its levels at the start of the year, underscoring just how extreme the preceding rally had been. Reduced geopolitical premium weighs on prices. Geopolitical risk has been a major support for precious metals in recent months. Fresh diplomatic signals and calmer headlines appear to have reduced near-term demand for safe haven assets. Lower energy prices and easing fears in key regions diminished the urgency that previously drove investors toward gold and silver. This episode shows how quickly geopolitical premiums can expand and contract in commodity markets. Long-term fundamentals remain intact, despite the sharp correction. Many analysts argue the longer-term case for gold remains constructive. Global debt levels are high, inflation dynamics uneven, and trust in political and monetary institutions fragile. In such environments, gold has historically served as a form of monetary insurance. Sharp pullbacks have often preceded renewed advances once macro uncertainty reasserts itself. Silver, while more volatile, may also benefit over time from its dual role as an industrial metal and monetary hedge, particularly if electrification and global growth trends persist. Investor Psychology Back in Focus. This episode is a reminder of how powerfully psychology shapes commodity markets. Rapid gains reinforce narratives of inevitability. Sudden declines can flip sentiment just as fast. For long-term investors, these moments test discipline and risk tolerance. For short-term traders, they underline how unforgiving crowded trades can become when the tide turns. Outlook ahead. In the near term, volatility is likely to remain elevated. Markets will be highly sensitive to signals on interest rates, central bank leadership, and currency movements. Any shift in expectations could trigger further sharp moves in either direction. Over a longer horizon, precious metals are likely to retain a role in portfolios seeking diversification and protection against systemic risk, though investors should expect turbulence along the way. Final assessment. The collapse in gold and silver reflects a violent but not unprecedented correction after an extreme rally. It marks a repricing of risk, expectations, and positioning rather than a definitive end to the broader precious metals narrative. For investors, the lesson is clear. Gold and silver can offer long-term protection, but they remain highly volatile in the short run. In a world shaped by political uncertainty, monetary shifts, and speculative capital, perspective and risk management are essential.